Nancy, I turn to you now because this was a pandemic story. That pandemic seems like it was yesterday's story, right, or 2 years ago's story at this point. Is this one of those companies that has a bright future even without a pandemic spur?
So, Dom, I think Frank is right that this is a company that's become very cheap. I mean, we look at relative price to sales ratio, and it entered into our ranges recently. It's down 71% from the peak, so it's tempting for investors. And we've seen multiple contraction, but it still trades at 45 times next year's earnings. And I think the billings question, as Frank mentioned, is going to be the all-important thing to watch today. They have a very tough comp year over year. Last year, billings were up 54%. So the company has a tough comp. They're expected to come in around 9. If they meet that, the stock will probably be fine. But I actually think you also have to pay attention to their new go-to-market strategy because they need to raise average revenue per customer. So I'm on the sidelines with this one. I want to see what comes out of earnings. Valuation is there for sure, and there is potential growth with the new Microsoft deal. But some of these really high flyers have come down to earth, and they may still have further to go.
All right. Now, by the way, thank you very much, Frank, for the story there. A quick programming note here. DocuSign CEO Dan Springer will join Tech Check tomorrow morning to discuss those big earnings results after our close today. He'll be live 11 a.m. Eastern Time, 8 a.m. Pacific Time, a first-on interview that you will not want to miss with DocuSign CEO tomorrow on Tech Check. Next up, Stitch Fix. Shares are down 55% this year as the subscriber growth slows and the path to profitability still isn't clear for that company. CNBC.com retail reporter Lauren Thomas has the story on this here. Lauren, can Stitch Fix get things going in the right direction?
Yeah, Dom, that's the big question, right? This company has certainly been pressured, not just this year, but, for a number of months now. Shares down about 55% year to date, like you said. If you do recall, last quarter, Stitch Fix cut its revenue outlook for this fiscal year. It also totally withdrew its earnings guidance, saying that there were a number of things that it needed to reevaluate, really its cost structure. So that includes marketing expenses, supply chain expenses, which are certainly weighing on a number of companies right now. The big thing that Stitch Fix really has to figure out, under CEO Elizabeth Spaulding, the company rolled out this new direct buy option. It's called Freestyle. And essentially last quarter, what the company told us is that rollout didn't go as smooth as planned. The company didn't onboard as many customers as it anticipated. So we're really looking for improvement there this quarter. The one other thing I'll mention is last quarter, Stitch Fix was facing supply chain delays anywhere between 4 to 5 weeks. So we're certainly looking for that timeline to decelerate some as well.
All right, Lauren, let's turn now to Nancy. As an investor, how important is profitability in this kind of an environment where interest rates are on the rise?
Yeah, I think this company is one you want to avoid at all costs. I mean, it's down 42% from the IPO. They, as was just mentioned, the Freestyle rollout was terrible. The leadership has been challenged, and subscriber growth in this return to fashion time has declined 161,000 quarter over quarter, and they've guided down twice in the last 2 quarters. So I think that you really have to stand aside and say there's probably a better place to be in retailer. If by some miracle they beat, I'd take the gain and run, because I just think this company is doomed,
all right,
frankly.
It could be a volatile trade for sure with a stock that's been beaten up as badly as that. Lauren Thomas, thank you very much for the story on Stitch Fix. Finally, we're going to turn to what's happening now with Vail Resorts. Those shares are down 20% on the year as macro headwinds persist. While folks are eager to travel post-pandemic, we know this, consumers are also dealing with surging inflation, sky-high fuel costs to get anywhere right now, road trip or otherwise. However, shares have jumped now in 3 of its last 4 reports. Our own travel guru, Seema Modi, has the story on Vail. Are as many people going to be out there skiing in the coming months ahead?
That's what we want to know, Dom. Vail has come under pressure in recent months. Specifically, earlier this year, there were pictures of ski resorts overcrowded, and Vail Fail became a hashtag that was trending on social media, customers blaming the company for selling too many passes. Now, since then, it's raised the price of its Epic Ski Pass. Question now is, going into the 2022-2023 ski season, what do sales look like? Are there plans to add more staff to the mountains to reduce the wait time at the ski lift, and is a very strong summer travel season, encouraging people to book trips for the winter. Vail has historically had a very strong pipeline as well, Dom, a presence in Europe and Australia, which people might not necessarily know. They tend to think of Vail as they should. So that will also be a key topic of interest when the company reports.
All right. So, Seema, those are all excellent points. I wonder, Nancy, if you're an investor in a company like this, it isn't just travel and leisure, but it's very seasonal travel and leisure. There has to be a lot of forecasting and expectation that goes into the investment thesis for a company like Vail. What exactly then does the Vail story tell you about whether you should be buying the stock or not?
Yeah, this is a tough one. It's really interesting to me, Don, because it has come down. It's experienced multiple contraction. It's down 25% year to date, has a dividend yield of 3%, which is interesting. But 90% of revenue comes from the ski resorts. And my residence is in Incline Village, Nevada, which is Lake Tahoe. And we're in a very long seasonal drought. I mean, it's been many years now. And so this one has the added difficulty of forecasting snowfall patterns, and they haven't been good. So the ski pass sales are important, of course, and we'll be watching that in the earnings report. But we're really not going to know anything until later this summer. And so I think that's why you have people sitting on the sidelines waiting to see what's going to happen. And the forecasts for snowfall are really not robust. So that's just something that has to be thought about as well.
All right. So the big trade there on vacations in the wintertime. Thank you very much, Seema Modi. And also for Nancy Tengler, thanks so much, both of you, for joining us today on the Earnings Exchange.